Hello and welcome back to another episode of the Mortgage Musketeer. Today I'm going to be focused on rates, and the main reason I am going to do that is because there are so many misconceptions out there about rates, and one of the questions that we as loan officers get all the time is, what is your rate? And the truth is, it's not our rate, it's the borrower's rate, but I know what they're really asking. Where are rates? What's happening to rates? And I wanted to give you a picture of the mortgage-backed securities that actually tells the tale of what rates do, which is why it's very difficult when somebody asks, what's your rate? It depends on the day, right? So if somebody were to get qualified here on July 13th and doesn't find a home until August 15th, you can see there's a massive difference in where the rates are. So the real question is, what impacts rates, what has happened to rates, and what's going on? Now, my intent in this video is not to teach you all about technical analysis, but it is to give you a little bit of a larger view of what has happened to rates overall, where we're at, and where we might be going. This is a quick 2-year picture of where rates are, and this is a mortgage-backed security. So mortgage-backed securities are actually what impact interest rates, mortgage interest rates, and they have an inverse relationship to the treasury, okay, to the bond market. So when we're looking at where rates are, we're really looking at mortgage-backed securities. And these mortgage-backed securities, when they go down, rates go up. When they go up, rates go down, right? Again, an inverse relationship. So this over here was back in February of 2022 when everybody was living large and 2 and 3% interest rates. And then after printing trillions of dollars worth of fake money, if you will, and propping up the economy during COVID, the Fed decided, oh my gosh, we got massive inflation, and they started to raise the interest rate. Now that had an indirect impact, but it did impact mortgage-backed securities. And as you can see, it begins to go down over time, which means interest rates went up. So this is from February until basically the bottom in October, the fastest interest rate increase in history. And then from here, we bottomed out, and then we started to work on the economy. Now understand that the point of this is to drive down inflation. The only real lever that the Fed has is to increase interest rates. Now it does have second and third order of effects, but the idea is to lower inflation. The issue is that the inflation model is a 12-month moving window. So it's very difficult to tell if what they have put in place has actually had an impact until a year from that point, as that window slides along. So it takes a little while for the economic data to impact the mortgage-backed securities and the economy. So what happens here is we start to look at things that impact interest rates. Now, I want to just orient you to all these different numbers. Don't get too wrapped up around it. Just understand that most of these movements here have to do with fundamentals. Fundamentals is what's happening both in the economy, in the nation, and in the world. So when things impact global economies, they have an indirect impact on us, which can impact more other aspects that then impact mortgage-backed securities, and that impacts interest rates. So, but internally, the whole point is driving inflation down, but there's other factors and fundamentals like jobless claims and the core price index and inflationary numbers and there's a whole bunch of different economic impacts that are evaluated all the time, and these create fundamental shifts in the market. Now, when there is no news, no fundamental news, then you go into technical analysis. Now, these numbers through here are something called Fibonacci's. Fibonacci is life. Don't worry about it. You can look it up, but understand it has an amazing reaction to technical analysis. Like it's crazy how accurate Fibonacci numbers actually work. There's also moving averages that we see here. So it basically takes a picture of what's been happening over time, and those are trending data. And then these are stochastics, right? And this basically is the market exhausted in one direction or the other. That's very fundamental. We don't have to go too deep into it. What we really want to look at is kind of drill down into what has happened to interest rates, so you can better understand when you ask where are interest rates, why it's harder to say depending on what's going on, okay? Every single day could be different. You see some of these days huge market moves. Now, a huge market move doesn't necessarily mean a massive change in interest rate. It can, but not always. So in this case, when we reached the bottom, we began to see a slowdown, and the bond market and mortgage-backed securities reacted positively. So we had a couple different impacts to it until November 10th, when we started to see a hint that inflation was getting under control. So it spiked up, and then it began trading, and this is a range. So if you look at this bottom here and you look at the top, this is a trading range. So it reacts to up and down to various fundamentals that don't move the market very far up until we get to February 3rd. Now this is where all of a sudden the jobs data came in for January, and it made it look as if there was 100 bazillion jobs that were added. And a lot of it had to do with some really cooked books and adding in undocumented workers and some other things. And it really began to push the mortgage-backed securities back down, which raised interest rates. So then we got all the way back down here in March, and it was just a big negative impact. And then we had some more fundamental news saying, hey, stuff might be getting a little bit better. And then it reacted and went back up in here. And from here, from basically March through here, which is May, so March through May, we were in a trading range, up and down, up and down, up. Really nothing moving the market massively fundamentally. So in this range, we're somewhere between, depending on how stable the market is, you had interest rates somewhere in the high 5s to the low 7s. Again, depending on all the other factors that impact somebody's interest rate. Okay, but once we get down here, then in May, then they start to talk about, hey, the economy is still hot. There's still a lot of jobs being created, and it's pushing mortgage back. Basically, when they're saying it's too hot, and then the Fed is raising rates, and they're saying I got to cool down the economy, and then fundamentally they get a little bit scared. Well, they get down to here and then say, okay, in May, all right, I think we've recovered. We got a little bit better data. In here also we had issues with used car prices still going up, so that kind of settled and got created. We got some news, then we went back into trading range, and then we come back into June. We've got more economic data. It's hotter than it's supposed to be. We keep putting in jobs, right? And a lot of the job data is really kind of falsified in a way. It just doesn't necessarily make sense. There's a lot of projections and a lot of estimates. And then what happens is all these job gains get revised, and then they say, oh, it wasn't as much. Oh, we strip out this stuff that was kind of BS, and we strip out this stuff that didn't really matter, and then it recovers again. And then we also end up back here, going back down again. Now in here, some of these are where you have the government fighting for putting the debt ceiling. That fundamentally drove prices down, and then it recovers. And then we have more bad economic data, right? Where it's saying, hey, that the economy is just too hot. We have to cool it down, right? And that's kind of what's been going on over since August, all through August here, to the point where we're actually to the lowest point that we were before. Now, where interest rates were here versus where they are here, that doesn't mean that they're equal. So it just depends on the market and bond market and all kinds of other factors. So interest rates actually got higher here than they have been in the past 20 years. Well, now we've got additional data saying, oh, hey, things might actually be cooling down. We might be better off than we are. Some of that data, the 12-month moving window, et cetera, et cetera. We're starting to get a little bit better data, and it kind of moves back up into here. The issue that we have here is now we're under technical analysis, right? So we've got these ceilings that we got to break through. We've got these moving averages that we got to break through, and all that creates resistance. So when we get closer to what happened, you see that, hey, we had some, better understanding of the economic data. It's here at this Fibonacci number. It's trying to break through. It's kind of hovering around it. And it's got these moving averages. In order to move above here, we have to have some strong fundamentals, right? And you have some trading trend lines that come into play. This is a bigger trend line. There's all kinds of technical analysis that come in. There's a lot of stuff fighting interest rates getting better. Ultimately, what's going to need to happen is some better fundamental news. But if you look at even from March until now, and this gives you a better picture. So when you ask, hey, what are your rates? That's difficult to tell. I mean, look how precipitous these drops are. Look how quickly it can recover. But understand when it goes back up, mortgage rates are fast when they go down to increase. They're slow when mortgage-backed securities go up to go down, right? Because what happens here is you see volatility, right? So volatility means risk. So that means that the traders and the lenders and everybody else, they're going to manage their risk. So they're not just going to go, oh, rates are better, and drop the rates a massive amount. It's not going to happen. It just takes time. And then certain rates, like your government rates, sometimes they'll be held a little bit higher because there's more risk involved in them. And then once the market stabilizes, like when it's in these trading ranges, this is relatively stable. Once it stabilizes, this is very stable, then those rates drop because there's less risk. So depending on if it's a government or it's a conventional, or USDA, jumbo, there's all kinds of different factors and different rates and different loan products. All of this impacts it. So I wanted to give you a big picture of where it is. So when somebody says, hey, what's your rate or what are rates? It's not that simple. It is simply depending on the day and what is going on, and fundamentally, what is the borrower's qualifications in relation to what is happening in the overall market. All right, so I wanted this to be a baseline, and what I'm going to be doing is covering this once a week so that people can understand where rates are moving, where we're headed, what's going on, and what's impacting the market, so that we can all be smarter. We can all educate our buyers as they're trying to navigate a world that they don't live in, but we do. So until next time, that's all for one and one for all, and I wish you the best.